Hello dark traders, welcome to Darkwave Trading, and as always my name is Darksins. So today we're going to go over some of the terminologies as used in Forex. We're going to have 3 of them. First of all, before I continue, I normally start by asking you, why are you here? Why are you doing this? Hoping that you have the right reasons. And after that, I normally proceed to give you this disclaimer, which I'm hoping you're going to take your time and go through it. Then after that, today we're going to go over some of the terminologies that you're going to come across in Forex, and I'm going to try my best and explain them to you in a manner that you're going to understand. So without wasting any time, let's do this. Okay, so first of all, we're going to begin with a currency pair, right? A currency pair is not that hard. A currency pair in Forex, and I'm going just to show you here. All of this in my watch list. This is my watch list, and this is trading view. All of these are currency pairs, right? All of these are currency pairs, and in currency pairs we normally have major pairs and minor pairs. So major pairs is something like GBP USD, Euro USD. That's a major pair. Major pairs basically involve the US dollar, right? Euro USD, GBP USD, all those are major pairs, right? Then minor pairs are those that do not have the US dollar in them. For example, GBP AUD, it has a major currency, like the pound is a major currency, Euro JPY, the Euro is a major currency, right? But it doesn't have the USD. That's why it's a minor pair. And after that, we normally have exotic pairs, especially for example, Audi CHF, that is the Australian dollar and the Swiss franc, right? That's an exotic pair, I think. Not really sure, but I'm trying to explain something here. These things I just want you to know, not that they have that much of an importance, right? Now, there's something else I want you to know. I want you to know the base and the quote currency. We're going to use an example of Euro USD. This is trading view. So you see this is Euro USD, right? So the first one, Euro, that is the base currency. Then USD, that is the quote currency. Are we together? Euro USD, that is the first one, is the base currency, and the second one is the quote currency. And here you can see the price of Euro USD, right? Right here you can see the currency we have here is the quote currency. And what this number simply means is that you need $1.0715 to buy 1 euro. Are we together? So you need 1.05155 USD to buy 1 euro. And I'm going to try another example with something like CAD JPY. So CAD JPY, this one, CAD, Canadian dollar, that is the base currency. JPY, Japanese yen, that is the what? The quote currency. And the price here is 1.0157. And notice what we have here is the Japanese yen. That simply means you need 111.046 Japanese yen to buy 1 Canadian dollar. It really is that simple. It's just that simple. That is what we mean by the base currency and the quote currency in how they interact with each other. Let me do a final example and then I'll be out of there. So let's go to GBP CAD. GBP, British pound, that is the what? That is the base currency. CAD or Canadian dollar, that is the quote currency. And the price we have here is 1.70898. What that simply means, and you see here it's Canadian dollar. You need 1.7089 Canadian dollar to buy 1 British pound. Are we together on that one? So after that, now we're going to go over correlation. Okay, correlation measures the relationship between two or more assets, right? Some assets are positively correlated, and when an asset is positively correlated, it means the asset move in the same direction, while negative correlation means that they move in an opposite direction. And I'm going to try my best to show that to you. Okay, let's talk about positive correlation. You see, most of the time, Euro USD and GBP USD, that's Euro USD and GBP USD are positively correlated. And what that simply means is when an asset is positively correlated, it means that they move in kind of like the same direction. When one pair is moving, it's bullish, and by bullish we mean it's buying, right? It's on an uptrend. Then the other one is going to also be on an uptrend. So those are pairs that are positively correlated. See, the first one is on an uptrend, but the second one is also on an uptrend. See, these are positively correlated. But you see, a pair that is negatively correlated, you see the first one is on an uptrend, but the second one is on a downtrend, right? Let me use color red. So these ones are positively correlated, right? When the first one is on an uptrend, the second one is also on an uptrend. But if two pairs or two assets are negatively correlated, when one is on an uptrend, the other one is on a downtrend, and the vice versa is also happens to be true. That is what we mean by correlation. And in a chart, I don't know whether I'm going to manage to do that. Let me hide this, right? See, this is GBP USD, right? I'm going to want to add Euro USD here. I don't know if I'm going to manage. Yeah, I have limits. Let's see. Now this line chart you see here is for Euro USD, and this candlestick chart you see here, that is for GBP USD, right? And you can see that they kind of like have the same structure, right? It's like they're moving in the same direction, and that is what we call positive correlation. It's like when it's selling, the other one is selling too. When it's buying, the other one is buying too. Just look at the structure and you see it's like they move together. It's like they move in the same way, right? That is what we call positive correlation. Let me try and no, I've removed that one. Now let me show you something. Let me show you negative correlation. Right, I'm going to hide that. Negative correlation, we're going to add DXY here. Is it going to be fine? Let's see. Because I understand DXY and GBP USD most of the times are negatively correlated. Perfect. See? Yes. You see, when this one was selling, the line chart is for DXY, and DXY is an index for the US dollar on its own. It shows how the US dollar is performing on its own, right? You see, now when GBP USD was selling, right, the dollar was buying, the dollar index was buying. You see, it's the opposite. It's always the opposite. Now this one is what we call negative correlation. That is negative correlation. Now you know about correlation, right? Let's proceed to the next one, which is divergence and convergence. Divergence occurs when price of an asset and a technical indicator move in opposite directions. I don't want to really get into technical indicators, but for now, but it's good you get to understand what it says. And convergence is when the price of and the indicator move in the same direction. That one I can use What can I use? I don't really have an indicator I can use to show that one to you, but it's all right. Now let's get to technical analysis. Technical analysis, it involves studying historical price charts and using various technical indicators to forecast price movements. And then fundamental analysis, it involves evaluating economic indicator, interest rate, political stability, and other microeconomic factors to predict currency price movements. All right. And quantitative analysis is where they involve using mathematical models and statistical techniques to analyze financial markets and make trading decisions. I'm going to explain each and every one of them in a way that you're going to understand. Algo trading or algorithmic trading is involves using computer algorithms to automatically execute trading strategies based on predefined criteria. So for technical analysis, there's a tool we use, and for me, I normally use TradingView, right? And if you don't have a TradingView account, you need to create one. And if you do have a TradingView account, or if you're starting out, I'm going to make a video to show you how to use TradingView. Wow, right? Let me show you my TradingView real quick. This is my TradingView, and as you can see, this is where we come to do technical analysis. This is where that happens. All right. This is where we come to do technical analysis. And for example, technical analysis where you use historic price movements to try predict. I did that. All of these things, you see me drawing a few things here and there. This is what we call technical analysis, right? To try and predict what the market is going to do and to have your position ready. And as you can see, I have in my watch list, this is where you get to have all your pairs, the ones that you deal with. And for me, I deal with a lot of them. I basically deal with almost all of them. Right. If it's going to give me a trade, I normally put it on my watch, a red list. I normally call it a red list, and then I'm going to look or focus on it, right? After that, this is where you get the tools that I am using to draw over this. And this one is a candlestick chart. This candlestick chart, and this is basically what we do. We just study these charts because it looks boring, and at first it wouldn't make any sense to you, but it soon is going to make sense to you. Now that is for us. We do technical analysis, and then fundamental analysis. We normally go to let me show you something like Forex Factory. We go to a place like this to check for. See, this is Forex Factory. And you see, like today, it's on Wednesday, there's this economic calendar showing me that we are going to have news, right? We are going to have news, and it's a red folder, right? It's a red folder news, which means it's going to highly impact the market, right? So I normally start by coming to check here, right, to understand the fundamentals before I continue to go do some technical analysis, because sometimes when the fundamentals are at play, technical analysis sometimes it works, but most of the time when news is at play, it doesn't work. Let me be honest with you, for me at least, it doesn't work. But that doesn't mean there are people who don't trade news. This is what we call the Forex news. All right. That is fundamental analysis. Quantitative analysis is where they have mathematical models. We have hedge funds. Hedge funds are a fan of this. They use this one. Or algorithmic trading. You've seen or had trading bots. And I bet someone has tried to sell you a trading bot. I don't know. Now let's go over to a bull market. A bull market is characterized by rising prices, right? Prices are rising. It suggests an overall positive outlook on the market, and the bear market is the opposite, characterized by falling prices and pessimistic investor sentiment. Sentiment is what someone thinks about something. What's your sentiment on this, on that? My sentiment on GBP USD is that the US dollar is going to increase in value. Therefore, when the US dollar increases in value, GBP USD is going to be bearish. Bearish means it's going to be in a bear market. Bear market means it's going to be selling. All right, it indicates an overall negative outlook on the market. Okay, I'm going to go explain this one, each and every one of them, step by step, slowly by slowly. Candlestick chart is a type of chart in technical analysis, and in technical analysis we go to trading view that displays the open, high, low, and close price for a specific time period. The body of the candlestick represents the open and closing prices, while the wicks of the shadows show the high and the low. Then we have something called resistance and support. Resistance is a price level where a currency has historically had difficulty moving above, right? Support is a price level where a currency pair has a difficulty moving below. I'm going to show each and every one of these ones. So, for example, this is Australian dollar, our decode, Australian dollar versus Canadian dollar. This one has been bearish, has been in a bear market because it's moving, it's bearish, it's moving down. Let me say that it's moving down. It's selling, right? It's been selling for all this time. That's bearish. I hope I can get something bullish, but for this specific time, from here to here, it was bullish. It was going up, right? It's in an uptrend. Let me say an uptrend. It's moving up. Yes, that is what we mean by bearish and bullish. Here it was bullish, and here it switched to be bearish. This is a bullish trend, and this is a bearish trend. And at this point is where the trend reversed, right? This is where the trend reversed. I'm just saying that we're going to get into details once we get into technical analysis, and that is that. After that, I've mentioned something about a candlestick chart. So there are various types of charts. Let me hide my drawing instrument. All of these are candlestick charts, because if you look carefully, this looks like a candle. This looks like a candle, like. So we have candlestick charts. We have bars, they look like that. We have line charts, they look like that. But my favorite is that one. And when we are checking for volume, we like those ones, right? There are many of them. I've never looked or tried any of these, but they are there, right? But let's focus with the candlestick charts because they happen to be my favorite charts. And a typical candlestick looks like this. Okay, let's go somewhere where we don't have any distractions. A typical candle looks like this. We're going to fill it with something like red. Didn't work. We are going to add up to there, and then we're going to draw the wicks. Yes, that's the upper wick. Don't mind my drawing. I'm just trying to explain something to you. Let's have the color of this one. Let's color it green. Then we're going to duplicate it. We're going to duplicate this one and have a red one, because I'm trying to show something to you. Well, let me just it's not working. I'm supposed to come here and clone and have it, come on, have it there and there, like that and like that. That's how candlesticks look like. Let's have this one red in color. Let me explain something to you, right? You see, the candlestick chart is just these blue ones, red ones. Blue ones are when the market is moving up, and red ones is when you can set these things where you do your technical analysis, and I do it in TradingView. I'm going to give you a link later. I'm trying to show you that when you see these candles, each candle you see here, let me just delete this stuff I have here. No. Every candle you see here, there's something we call a time frame. You see, this is 1 minute, 5 minutes, 15 minutes. Now it's in the 1 hour. So every candle you see here represents 1 hour, right? Price movements in that hour. See, like this one, it was the price action of our decode 4 p.m. Friday on the 24th. Friday, on date 7, Friday. Right? Then the next one is for 5 p.m. Right? So from 4 to 5, this is what happened. That is how we have this candle here. And these candles, they have points, right? So it depends with what candle you're dealing with. That is the opening price there. What I've pointed, that is the opening price. No, I'm sorry. If the market is buying, that is the opening price. And when that hour is over, that becomes the closing price. This is the opening price when that 4 p.m. is opening. Therefore, that means a 4-hour candle, a 1 hour candle is starting to form. That is the opening price. Immediately at 4 p.m., whatever time it is. And then it does whatever it does for the full hour. It goes even up to here. Then finally, when it's at 5 p.m., it closes here. This is the closing price. Then this one is the high and this one is the low, right? Coming to here, so for example, we can have these two candles. Yes, the way just the way they are. Only that I'm going to do this to this one, and then maybe move them closer. Yes, let me move them closer so that I can be able to explain what I want to explain here to you guys. There. Let's have it there, right there, and this one. So we've said, because this is a 4-hour time frame, we have a 1 hour time frame. Sorry, we have a 1 hour candle forming. So it has, let's say it's 4 p.m. It started forming. This is the opening price, and then it forms a low. This is the low, and does whatever it does, forms a high, and closes here. That is the closing price. Once it closes at 5 p.m., another 1 hour candle starts to form. It forms a high and then sells, gives us a low, and this is the closing price, and that is where we're going to probably get another candle. Maybe it's a selling candle. Yes. What the hell is going on? What is happening? Yeah, right here, this is where they don't mind my chat work. All right, you see, that is how the market moves. Then now this is 6. This is the candle that started forming at 5. It finished forming, it closed here, and then another candle started forming at 6. We get a high, it sells, we get it. That is what you're seeing here. That is what you're seeing here. Right? That is how you interpret these things. Wow, this has turned out to be longer than I expected, but I hope you can understand me. But when we get into technical analysis, I'm going to explain these things even better. I was supposed to explain about resistance and support, levels of resistance and levels of support. Let me show you. Levels of resistance, we have said, it is a price point. It's a price point. Let's start with support. This is a level of support. This one. This is a level of support because every time price came to that level, it had a difficulty going below. It's like it's supporting the candles, right? And they start going up. That is buying or bullish, right? It did that for the first time, for the second time, and this is for the third time. It's a price point. It's a level where price has a difficulty going below, but eventually it managed to go below. So now what I'm trying to look for is a level of resistance, and right here, it's right here. It's a level where price has a difficulty going above. Every time it hits that level, you get that price action where the candles are selling from that point again and again. That is what we call resistance. I'm really glad it gave me quick examples pretty fast. That is that. Now finally on this one, let me explain about volatility. And volatility is simply the measure, the degree of variation of trading prices in a series, trading price series over time. High volatility implies larger price swings, while low volatility suggests smaller price movements. Right? Let me explain volatility to you. Right? We normally get high volatility when there's news, right? And we check for news where? From Forex Factory, right? When we are going to have news, for example, on today, Valentine, on Wednesday, 6 p.m., we are going to have news for British pound. And when we have news for British pound, every pair that has the pound with it, GBP, Audi, British pound, every pair that has the British pound on it is going to be affected by, even this one, GBP USD, is going to be affected by news. And when the news are active, 6 p.m., everything that has GBP is going to be highly volatile. Okay, it's going to, volatility is when you see prices moving like this, right? We can say the 1 minute time frame is volatile. The 1 minute, I don't know if that is accurate, but no, this is not a good example. A good example, there are pairs which are highly volatile and there are pairs which are not volatile. See, a pair like gold is highly volatile, and by that you can see, let me explain this to you in a way you're going to understand. For example, this is how long. This is a tool. You can see how long. Right. So you can see that time where 2 hours. Can you see 2 hours somewhere in this red thing? You can see 2 hours, or 1 hour 45 minutes, or 2 hours. You see, gold in this 2 hour time, it dropped for 390 pips. I'm going to explain about pips later. 390 pips, right? For 2 hours. But you can see something like Audi CHF. Let me use that one because it's a good example. Or Euro CHF. You see that one dropped like that for 2 hours, right? 390 pips for 2 hours. Let's measure this one. All right, this one happened in wow, I bet there was news here, but this is not that volatile. Let's even measure for 2 hours. It looks like a big impulsive buy move for 2 hours, but it's only 58 pips. I hope you can see the difference. The difference is, yes, the time is the same, but the price movement is not the same. Gold is highly volatile because it can move a higher range in a specific amount of time compared to other pairs. So you see, gold takes 2 hours to move 390 pips, and even this one has taken 1 day, 10 hours, 48 minutes, but it didn't even manage to go. It managed to go 95 pips only for 10 good days. 1 day, 6 hours and 45 minutes. I know you can't see because of this one. Let me measure again. Gold took 2 hours to go for 390 pips, but this one has taken 1 day, 8 hours to move for 93 pips only. This is not highly volatile asset compared to gold. Gold is mad. Gold kills everyone. If you are on the wrong in gold, you're going to be massacred. You're going to be pretty much massacred. Gold moves like crazy. That is what we mean by volatile, and most of the currencies are volatile when we have news. I hope that point is home. So sometimes you might wanna be cautious when there is news. So let's focus or talk about the slippery market. Is a market condition characterized by high volatile and rapid price movement, making it challenging to execute trades at desired prices, you come across a term called slippage, and this one happens during news again. News, and by news, by Forex news, I'm talking about the ones you'll see in Forex Factory, not the ones you see in your TV. During those moments, markets are pretty slippery, right? Overbought and oversold refers to the condition in the market when the price has risen or fallen too far and is likely to reverse. Let me explain that to you. Or overbought condition may suggest a potential sell signal, while I don't really check for these ones, but it's good to understand. I'm going to just draw instead of looking for an example. I'm going to see an example. Let me see. Okay, let me use these two instances. All right. Let me use these two instances. We are going to look at gold from here to here. You see, we can have an uptrend going on and on and on, but there reaches a point where people who are looking at the market are thinking that this thing is way overvalued. All right, you can consider something that is overvalued as overbought, and there's a high likelihood of it reversing. Same goes for oversold. Now, oversold, we are simply going to focus on this part, trying to explain. But when you spend your time in Forex more, this point here, the market was just selling and selling. Oversold is the point where it gets and people are like, this thing is way undervalued. So it's kind of like going to buy. So people prepare themselves to buy together with the market as it buys. Right? Oversold and overbought, you're going to have your way around that. Do your research. I know you can do that. Fibonacci retracement, finally, on my analysis terminologies. I also have a few. Fibonacci retracement is a technical analysis tool. We go to where? We go to TradingView. Once we go to TradingView, we are going to want to look at the tools. Right? You see, this is where we have our tools, and you can see Fibonacci retracement. A Fibonacci retracement, you use it, you pull it on price, and this one helps you to know if it has a few numbers. This one we call equilibrium, 50%, and above equilibrium we consider this as premium. Below equilibrium we consider this as discount. When price moves to premium prices, there's a high probability of price selling. When price moves into premium prices, there's a high probability of, because they normally say we buy at discount, we buy low, and buying low is buying at discount, and we sell high, and selling high, it's selling at premium. Let me show you something. Let me show you an example, because I'm pretty sure I'm going to get one. Let me show you. I'm going to pick this range, and I'm going to want to try and explain using this range, right? This range here. I'm going to take my fib and pull it on this range here. From here, a range is from a high to a low, or from a low to a high, right? Let me increase the thickness of that. That's our range, right? We've placed our Fibonacci there, and this is our equilibrium, that is the 50%, right? Above equilibrium we call that premium, and below equilibrium we call that discount. At this one, there's a high probability of price reversing, and you see it tried to sell, and eventually price sold, right? And at discount, there's a high probability of price buying. You see, the moment price got to this, this is the moment price entered here, it got there was a high probability of price buying, and that is what happened, and it entered the premium regions where there is a high probability of price selling. That is the fib, and we use it more often than not. And finally, I want to explain something here, and I'll be done. This is the longest video I've ever done at a so we're going to talk about the pips in Forex. Pips is the smallest measure that smallest price movement that a given exchange rate can make based on market convention. They're different, right? See, we have different assets. We have gold, right? We have gold, we have these other pairs, and we have yen pairs, right? So there's three ways. There's a certain way they differ, especially for yen pairs, right? And other pairs and gold. There's gold. Let me type that. Let me help you. We're going to say there's gold. Measuring pips, gold. There's gold. And there's when we are dealing with other pairs. And there is that for yen pairs, JPY pairs, everything that has the Japanese yen, right? So let's start with other pairs. Other pairs, we normally, let's go to other pairs like GBP USD is another pair, right? You see the price of GBP USD right now is 1.2. This one, you look here, this is where you see the price, this is where you see the price here, 1.26089, and by that USD, that means you need 1.26089 US dollar to buy 1 British pound, right? Now that being said, you see this price here, and I'm going to take my time and write it. It's going to change obviously, 26089, right? And sometimes you have another number after that, 1 2 3 4 9. It's good. How many decimal places can you see, right? I know you are a learned person, so tell me how many decimal places you can see. Let me make it larger. How many decimal places you can see? Let me use this one. There's 1 decimal place, 2 3 4 decimal places. First of all, we're going to focus on these 4 decimal places. So for every other pair except gold and yen pairs, the first 4 decimal places is what we're going to focus on, right? These first 4 decimal places. So let's say the number was 1.26000. Let's do that. And we see this is GBP USD. And then at a later time, price moves to 1.2650, right? You see these two numbers, this one is higher than this one. That means for us to achieve something like that, GBP USD will have obviously done something of the sort, right? So to measure this price range, we are going to simply subtract the two numbers, and that's how we get our pips. Now, as I have said, we're going to focus on the first 4 decimal places. Those ones, when you are subtracting, they are the ones that are going to give us the number of pips, so we can do something which is mathematically wrong. To do this, I'm going to enter, what did I just do, 2650. I'm just going to take it raw and then click enter. I'm going to subtract, click enter again, but this time around we're subtracting 26500. And what is the answer to that? And I suppose because you're smart, the answer to that calculation, what the hell just happened? All right, it has disappeared. Anyway, the answer to that is going to be 50. What we mean is that GBP USD has moved up with 50 pips for 50 pips. So every other pair, if you want to know the number of pips, just subtract these last 4 decimal places. You can do the same if we have something like 1.2500. What will have happened for us to achieve, this was the starting point. what will have happened for us to achieve that is that GBP USD will have sold up to that point, and that is where we're going to get that kind of number here. You can see those numbers are here, all of them. And to know what it has moved for, you're going to just simply subtract, and by doing so you're going to get the answer as what is the answer to that? What is the answer to 2600 minus 2500? That is like 500, and 500, that is what am I even saying? Let's do the calculation. I didn't intend for it to be that bad. Let me change this one to something like 2550. I wanted to 2550. You add 50 pips, you get to 2600, right? So GBP USD would have sold for what? 50 pips. Those are the pips. You see, the last decimal place, the fifth decimal place, is normally called a pipette. And when the pipette gets to like 9, 10, it jumps and it adds to 1 pip, right? So 10 pipettes equals to 1 pip. Just understand that. That is for other pairs, right? We were in gold when I was trying to explain other pairs and gold. So this is for other pairs. Other pairs like except the ends, like Euro Audi, it has 4 decimal places. The fifth one is a pipette. You use the last 4 to measure the number of pips. And you see, it's pretty simple. We have a tool. This one is for measuring, right? You can measure, and this one, you see, it has measured 4 pips. Minus 4, it means the price has sold for 4 pips, right? For 45 minutes. It even shows the time by which that price movement has happened. So you might want to play around with that. I was explaining. So for everything else apart from gold and yen pairs, we use the last 4 decimal places to know about the pips. Now let's go to something like Audi, JPY, or let's focus on yes. Fine. You see, for these ones, they have like 3 decimal places here. This is Euro JPY. What simply means is that right now, the price of Euro JPY, I don't know why it's not showing, is 161.293. It means you need 161.293 Japanese yen to buy 1 euro, right? Now, pips for yen pairs, we focus on the last 2 decimal places. That is the only difference. So let's say price moves from 161.00 to something like 161.50. This is higher. This is higher than this. That will mean that Euro JPY must have bought to get to that price. And to get to that price, the difference we use, you'll subtract using the last 2 decimal places to find out the number of pips that it changed. And if you do that simple calculation and subtract, you're going to get the answer here as 50. Forget about the others. 50. The answer here is going to be 50. Let me just do that for you. 50. So we will say Euro JPY has bought or has risen for 50 pips. It will rise for 50 pips from 161.00 to get to 161.50. The opposite is also true when we have something like 160.50. So if this is the starting point, this one is the starting point, and we get this, that means that Euro JPY must have dropped for a certain amount to get to 160.50. And once you subtract the 2, you get that the answer is still 50. So Euro JPY has dropped for 50 pips, right? So I've discussed for the ones with 4 decimal, the last one, the last decimal place here, the third one, that's a pipette. Once it gets to 10, it jumps to 10 pipettes equals to 1 pip, right? Now finally for gold. For gold it's a little bit different. Even when you try you try to use, you can use this one to make things easier. For this, like for this candle, it has moved to 123 pips. 123 pips. Yes, in 1 hour. I said that gold is volatile. See, for gold, if you're trying to do the simple calculations, it's a little bit complex, and I can say something that is going to be pretty easy. Or to start with, let me use something like 18 that 0.000. Maybe that is the price of gold, and then it moves to something like 18,855.00. Now this is 50 pips for gold. What you're going to do is you're simply going to subtract, and what happens when I do that? My values disappear. So 1885.0. Nice. This is 50 pips in gold. Gold, I tried to focus on these two numbers separated by the decimal point. Just subtract these two numbers. 50 minus 0.50 minus 00, that is 50 pips, right? It's going to be hard. I don't know how to explain this one for gold, but that is that for gold. It's normally like this. It's a little bit different, right? Let's use something like from here. Like from here, you can see the price is 1992.285, right? Up to this point, you see it sold up to this point, which is what? 1991.069. So once you subtract it, let me help you so that you understand. Let's put a price on this one. 1992.298. 1992.298. And this one here is 1991.087. Come on. 1991 point what? 1991.073. 073. Once you subtract these two, you are going to get you're supposed to get this, if you're not wrong. You're supposed to get, it has moved for 112 pips. Let's see if that is even possible. I've said you focus on, you see, everything from here. Oh, I have a simpler way. The simpler way is take every number from here, from the first one up to the last one should be this number here, the first decimal place, right? Let me have my calculator here to make things easier. For gold, take all the numbers together with the number which is the first decimal place. Let me see if using that angle I'm going to explain it better to you. What the my things are pretty slow. Let's do this. Okay, now let's input these numbers, right? I've said take every number, so this one is obviously higher than this, so take 1, take 9, 2, and the number after the decimal place, maybe we round off, that is going to be 3, right? Then subtract the other one, take the first, the second, the third, and the next one, and if we round off, it's probably going to be 1, like that, and you get your answer to be 12. And once you get the answer, just multiply by 10. Yes, that way it's going to be easy, and you get 120 pips. And if you measure from here with the accurate measuring tool, it's saying it's exactly 120 pips. 1920, you see? Yeah. Take the first, for gold, take 1, 2, 3, 4. The last number should be this one after the decimal place, and round it off. Then you subtract the other one, 1, 2, 3, 4, 5. The last number should be this one. You can round it off. But for yen pairs, focus on the last 2 decimal places. And for every other pair, focus on the last 4 decimal places. I think that way we are going to have an understanding. This video is long and I'm not even started, right? Finally, let me finish this off by liquidity. By saying what liquidity is. Liquidity is simply the ease with which an asset can be bought or sold in the market without affecting its price, right? There are places where there is high liquidity and low liquidity. There are times where there is high liquidity and low liquidity. When the market has low liquidity, we get things like gaps. I don't know whether you've seen gaps, especially in stocks. You see gaps. That is when we have low liquidity. When we have high liquidity, you normally get narrow spreads. Liquidity affects a lot of things, and liquidity in itself is a whole topic, and we're going to go over it in another video. I'm tired. Been talking for the last almost 1 hour. I'm tired. Let's break it at there. You have a nice time. Mom, I'm tired. I'm going to go over next in line is terminologies to do with what? Terminologies to do with execution, right? So let's